Ladies and gentlemen, welcome back to the channel. Beneath the towering skyscrapers of Manhattan, amid the blur of numbers and the echo of ringing bells, lies a story far older than most realize, a story of ambition, risk, and reinvention. Picture the chaos of a modern trading floor, shouting brokers, glowing screens, the constant pulse of capital. Now rewind the clock. Before algorithms, before hedge funds, before the New York Stock Exchange even had a building to call home. It all began on a quiet cobblestone street in Lower Manhattan. In the late 1700s, there was no financial hub, no trillion-dollar trades, just a group of brokers meeting under a buttonwood tree, trying to bring some order to the frenzy of buying and selling. That unassuming agreement would evolve into what we now know as Wall Street. But the journey from tree to titan wasn't smooth. Wall Street's rise is a tale of dizzying highs and devastating crashes, of Gilded Age wealth and Great Depression, ruin of secretive banking dynasties that shaped not just America, but the global economy. This was the birthplace of the American financial dream and nightmare. In this video, we'll uncover the real story behind the Buttonwood Agreement, peek into the power plays of J.P. Morgan and Rockefeller, revisit the panic of 1929, and trace the evolution of Wall Street from a back-alley trading post to a symbol of global finance and controversy. This is more than money. It's about power, people, and the pursuit of control. This is the untold rise of Wall Street. Long before Wall Street meant money, it meant survival. In 1624, the Dutch West India Company founded New Amsterdam on the southern tip of Manhattan Island. It was a rough strategic outpost, more trading post than city, built for commerce, not comfort. The Dutch were here to do business, exchanging goods like beaver pelts, tobacco, and timber with Native American tribes and European merchants. This early hustle laid the foundation for a city that would one day hum with financial activity. The street that would become Wall Street got its name not from bankers, but from barriers. In the 1650s, Dutch settlers constructed a wooden wall along the northern edge of their colony to defend against potential attacks from the British and native groups. That wall stood roughly where Wall Street runs today, and though it was torn down decades later, the name stuck, a relic of a defensive mindset that, ironically, would one day host the most risk-driven marketplace in the world. When the British seized control in 1664, renaming the colony New York, they inherited more than just land. They inherited a strategic port city ripe for trade. Over the next century, commerce grew steadily. Ships from across the Atlantic docked nearby, goods flowed in and out, and a rudimentary economy began to form. Wall Street evolved from a border defense to a commercial artery. By the time America gained independence, questions loomed about how this young nation would manage its finances. That debate played out between two titans of thought, Alexander Hamilton and Thomas Jefferson. Hamilton, the first Secretary of the Treasury, envisioned a centralized banking system and a strong federal financial infrastructure. Jefferson feared that such concentration of economic power would strangle the republic, preferring agrarian simplicity and state control. Hamilton's vision ultimately won. He helped establish the Bank of the United States, laid the groundwork for national debt management, and made New York a focal point for American finance. His ideas would shape the identity of Wall Street for centuries to come, not just as a place to exchange money, but as the nervous system of a rising capitalist empire. In the spring of 1792, a quiet revolution took root beneath the broad canopy of a buttonwood tree on Wall Street. 24 stockbrokers, tired of chaotic, unregulated trading and cutthroat competition, met and signed what would come to be known as the Buttonwood Agreement. On the surface, it was simple. They agreed to trade securities only with each other and to charge a standardized commission. But in that simplicity lay the foundation for something far bigger, the creation of an organized, professionalized stock market. At the time, America was still in financial infancy. Government bonds, war debt, and a few bank stocks were the main items being traded. Transactions happened in coffee houses, on sidewalks, and through whispers and handshakes. It was messy, inconsistent, and riddled with insider dealing. The Buttonwood Agreement was an attempt to bring order to the madness. By creating a closed network, these brokers built trust, a critical element for any financial system. It meant buyers and sellers knew who they were dealing with, prices stabilized, confidence grew. Though this early system had no trading floor, no marble buildings, and no flashing tickers, it had something even more powerful: a shared set of rules. The Buttonwood Agreement, signed in 1792 by 24 brokers beneath a sycamore tree on Wall Street, may have seemed like a simple pact, but it quietly launched a financial revolution. By agreeing to trade only with one another and fixing commission rates, these brokers created not just stability, but exclusivity, two key ingredients in the birth of a formalized market. This early move toward regulation laid the groundwork for trust and structure in an otherwise chaotic world of finance. As the nation grew, so did this network. What started as handshakes under a tree soon moved indoors, then into purpose-built halls, and eventually into a towering symbol of global finance. The New York Stock Exchange became more than a marketplace. It became a barometer for American ambition, innovation, and at times its greed. The Buttonwood Agreement reminds us that even the biggest institutions can start with a small idea and a handshake. It was a quiet beginning to a loud legacy, one that would shape economies, influence governments, and impact millions of lives across the globe. As the 19th century gave way to the Gilded Age, Wall Street became more than a marketplace. It became the command center of American capitalism. And at the helm were a handful of men whose wealth and influence reshaped the nation: J.P. Morgan, Andrew Carnegie, and John D. Rockefeller, names that echoed through marble banking halls and industrial factories alike. J.P. Morgan was the face of Wall Street power. A towering figure, both literally and figuratively, Morgan wasn't just a banker. He was a kingmaker. Through his firm, he financed railroads, consolidated industries, and essentially stabilized the American economy with the stroke of a pen. When the U.S. Treasury ran dangerously low on gold during the Panic of 1895, it was Morgan who stepped in, arranging a private bailout of the federal government. His influence blurred the line between business and state and cemented Wall Street as a central pillar of American governance. Meanwhile, Andrew Carnegie built a steel empire that turned America into a global industrial power. Though based in Pittsburgh, Carnegie's fortune was financed, traded, and multiplied on Wall Street. The same went for John D. Rockefeller, whose Standard Oil monopoly reached into every aspect of American life. These were the original tycoons, wielding fortunes measured in billions by today's standards, all rooted in Wall Street's machinery. This was the era of lavish mansions and sweatshops, of sparkling wealth and staggering poverty. Dubbed the Gilded Age by Mark Twain, it was a time when the outer shine of progress masked the rot beneath. Wall Street buzzed with speculation and excess. Insider trading, market manipulation, and unregulated stock promotions were the norm. Fortunes were made and lost at a dizzying pace. By the end of the 19th century, Wall Street was no longer just a physical place. It had become a symbol. It represented the promise of wealth, the engine of American capitalism, and increasingly, the dark underbelly of industrial progress. In the decades after the Civil War, the United States experienced an economic transformation unlike anything it had seen before. This was the Gilded Age, a time of explosive industrial growth, urban expansion, and technological innovation. Railroads crisscrossed the continent. Steel and oil empires rose to dominance. Banking and finance became more sophisticated and more powerful, and at the heart of it all stood Wall Street. Wall Street wasn't just a location for buying and selling stocks. It became the command center of capital. Through it flowed the money that built factories, funded railroads, and fueled American expansion. Investment bankers like J.P. Morgan became kingmakers, able to make or break entire industries. Stocks, bonds, trusts, and speculation were no longer tools used by a few elite traders. They were becoming essential elements of how the entire American economy functioned. But while wealth accumulated at the top, most Americans saw little of the prosperity they helped create. Factory workers endured 12-hour shifts in dangerous conditions. Child labor was widespread. Immigrants arriving in search of opportunity were often crammed into tenements and paid starvation wages. Unions began to form, strikes erupted, and the cry for labor reform grew louder. Against this backdrop, Wall Street came to symbolize the stark divide between rich and poor. Newspapers and political cartoonists depicted Wall Street magnates, Carnegie, Rockefeller, Morgan, not as heroes, but as robber barons. The term captured the growing perception that these men were exploiting the system, hoarding wealth while ordinary people suffered. For many, Wall Street represented everything that was wrong with unchecked capitalism: corruption, monopolies, and inequality. Yet for others, Wall Street still embodied opportunity. It was a place where fortunes could be made overnight, where ambition and risk were rewarded, and where America staked its claim as a global economic powerhouse. By the end of the 19th century, Wall Street had become more than a financial district. It was the financial brain of an industrializing nation. The world began to watch it as a barometer of power and possibility. Foreign investors looked to it for returns. Aspiring entrepreneurs dreamed of one day taking their companies public, and critics saw it as both a threat and a mirror, reflecting the best and worst of the new American age. In short, Wall Street had come to represent a paradox: the soaring potential of capitalism and the deep moral questions that come with it. By the early 1900s, Wall Street had become the beating heart of global finance, but with great power came great fragility. In 1907, that fragility was exposed in what became known as the Panic of 1907, a financial crisis that nearly brought the entire U.S. banking system to its knees. And in the absence of a central bank, there was only one man powerful enough to stop the bleeding: J.P. Morgan. It began with a failed attempt to corner the market on United Copper stock, which spiraled into panic as banks and trust companies started to collapse. With no Federal Reserve, no government safety net, and no deposit insurance, fear spread like wildfire. Investors pulled their money, banks shut their doors, and the stock market began to plummet. In a matter of days, Wall Street teetered on the brink of total collapse. J.P. Morgan summoned the nation's top bankers to his private library and took charge. Like a general in battle, he locked the doors and refused to let anyone leave until they pledged millions to keep solvent institutions afloat. He orchestrated the rescue of major banks and brokerages, restored confidence, and stabilized the system, not with legislation, but with sheer personal influence. It was a turning point, but also a red flag. The U.S. couldn't keep relying on one man to save its economy. In response, Congress created the Federal Reserve in 1913, an independent central bank designed to regulate the money supply, oversee interest rates, and act as a lender of last resort. It was a monumental shift. For the first time, the U.S. had a formal mechanism to respond to financial crises, born directly out of Wall Street's vulnerability. But Wall Street's troubles weren't over. On September 16, 1920, a horse-drawn cart stopped outside the J.P. Morgan and Carmard Bank headquarters at 23 Wall Street. Moments later, it exploded. The Wall Street bombing killed 38 people and injured hundreds more. Though the perpetrators were never definitively caught, it was likely the work of anarchists targeting capitalism itself. The attack was a violent reminder that Wall Street had become a symbol not just of wealth, but of power and enemies. Just 9 years later, that power would unravel in spectacular fashion. On October 29, 1929, Black Tuesday, the stock market crashed, wiping out billions of dollars in value. Years of reckless speculation, margin trading, and unchecked optimism came crashing down. Banks failed, businesses closed, and millions lost everything. The crash didn't cause the Great Depression on its own, but it lit the match that set the global economy ablaze. The crash of 1929 wasn't just a financial event. It was an emotional and cultural shockwave. In a matter of days, the illusion of endless growth shattered. Stock prices plummeted, fortunes evaporated, banks failed. And the roaring energy of the 1920s, a decade driven by consumerism, credit, and unrestrained speculation, came to a violent halt. Wall Street, once the shining emblem of American prosperity, now stood as a cautionary tale. The same trading floors that once echoed with optimism now fell silent with fear. People who had invested their life savings were left destitute. Stories of ruined investors jumping from buildings became part of the public consciousness, whether exaggerated or not. The crash exposed deep flaws in the system: lack of regulation, rampant speculation, insider trading, and a growing disconnect between the financial elite and the everyday American. What had seemed like a miraculous money machine turned out to be dangerously fragile, propped up by hype, loans, and little oversight. And so, the skyscrapers remained, but something invisible had collapsed. Trust. Confidence in the markets. In the banks, in the very idea of American financial invincibility, took a massive hit. Wall Street had led the charge into a modern capitalist age, and now it led the nation into the Great Depression. After World War II, America emerged as a global superpower, and Wall Street was the engine that financed its rise. Factories hummed, suburbs sprawled, and corporations went multinational, all backed by capital flowing through the canyons of Manhattan. The post-war boom wasn't just about prosperity, it was about projection. Wall Street helped fund the Cold War, space race, and the global spread of American consumerism. By the 1950s and 60s, investing had become mainstream. Stocks weren't just for the rich anymore. Middle-class families were buying in, retirement plans were tied to the market, and the New York Stock Exchange became a symbol of American vitality. Then came the 1980s, a decade that reshaped Wall Street's identity. Under President Ronald Reagan, a new economic philosophy took hold. Supply-side economics, or Reaganomics. Taxes were slashed, regulations were rolled back, and Wall Street became a high-octane playground for risk, ambition, and greed. The rise of junk bonds, leveraged buyouts, and corporate raiders turned financiers into rock stars. Michael Milken, Ivan Boesky, names once confined to boardrooms, hit the headlines. This was the era of excess, immortalized in films like Wall Street with the infamous motto, "Greed is good." Trading floors were wild, bonuses were massive, and the new gods of capitalism wore Armani suits. But behind the champagne toasts and stock tickers, the seeds of future collapse were being quietly sown. Fast forward to 2008, and those seeds burst into a full-blown financial crisis. Years of deregulation, subprime mortgage lending, and blind faith in the system led to catastrophe. Investment banks had become too big to fail, and when Lehman Brothers collapsed, the global economy began to unravel. Panic swept across markets. Housing prices tanked. Millions lost their homes, their savings, and their jobs. Wall Street was bailed out. Main Street was left to pick up the pieces. The public response? Occupy Wall Street. Protesters flooded lower Manhattan's Zuccotti Park, demanding accountability and decrying the 1%. For the first time in a generation, Wall Street wasn't just a place, it was a target. The movement didn't dismantle the system, but it ignited a new awareness of wealth inequality and financial power. And yet, Wall Street adapted. Out of the ashes of 2008 rose a new kind of financial empire, one powered by technology, data, and speed. High-frequency trading firms used algorithms to make thousands of trades per second. Hedge funds became kingmakers. Big tech, Apple, Amazon, Google, emerged not just as businesses, but as trillion-dollar market forces whose stocks could sway the entire economy. By the late 20th and early 21st centuries, Wall Street had transformed into something far beyond its physical borders in lower Manhattan. The ticker tape gave way to algorithms. Trading pits became server rooms. Human instinct was gradually replaced, or at least supplemented, by artificial intelligence and lightning-fast computation. This wasn't just a shift in tools, it was a shift in philosophy. Wall Street wasn't just about physical goods anymore. It was about abstraction, derivatives, hedge funds, high-frequency trades, and data-driven speculation. Entire fortunes were made or lost in microseconds. Decisions that once took days now happened in milliseconds, sometimes faster than human thought. It was no longer about the steel mills of Pittsburgh or the oil fields of Texas. It was about who could harness information first, but the power never left. From the post-World War II boom, when American industry rebuilt the world, to the tech-fueled surge of the 1990s and the globalized economy of the 2000s, Wall Street dictated not just domestic wealth, but international policy. Financial crashes in New York could ripple across Tokyo, London, and São Paulo within hours. Bailouts, bubbles, and booms all flowed from this one engine of influence. Wall Street today is part machine, part myth. Its players may wear AirPods instead of fedoras, and their weapons may be spreadsheets instead of ledgers, but the stakes are the same. Nations rise and fall on credit ratings. Industries live or die by investor confidence. the dreams of millions are still tethered to market swings. In many ways, it's no longer just a street. It's an idea, a force, a mirror reflecting both the brilliance and the blind spots of global capitalism. Wall Street's story is a paradox, a monument to both American prosperity and deep inequality. It built empires, created wealth, and helped millions achieve financial dreams. But it also concentrated power, enabled exploitation, and sparked some of the worst economic crises in history. Its legacy isn't simple. It's a constant tension between opportunity and excess. For some, Wall Street represents the pinnacle of freedom, a place where talent, risk, and innovation can turn ideas into fortunes. It's the engine that fuels startups, funds infrastructure, and underwrites the modern world. Without it, there's no Silicon Valley, no global corporations, no retirement accounts for millions of Americans. But for others, Wall Street is a symbol of unchecked greed and systemic failure. The 2008 crash left scars that still haven't healed. Bailouts saved banks, but not the people who lost their homes. Lobbying and deregulation often favor the few at the expense of the many. The wage gap continues to widen, and every market boom seems to foreshadow another bubble. This divide feeds an ongoing national debate. Is capitalism working for everyone? Or is the system rigged for the powerful? Should markets be free to operate without interference, or should the government play a bigger role in keeping them in check? These questions don't have easy answers, and they play out daily in our politics, policies, and public discourse. Culturally, Wall Street has taken on a life of its own. It's been mythologized in films, condemned in protests, and invoked in presidential debates. It's a metonym for wealth, power, and at times, villainy. Yet it's also a mirror, reflecting not just our economy, but our values, our fears, and our ambitions. Wall Street's global influence in the 21st century can't be overstated. It functions more like a central nervous system for the world economy than just a physical financial district. The term Wall Street itself has become shorthand for a complex web of institutions, technologies, ideologies, and decisions that transcend borders and time zones. When markets open in New York, traders and analysts in Frankfurt, Mumbai, and Hong Kong are already watching. A dip in the Dow or a shift in the Fed's interest rate policy can send shockwaves through global currencies, affect commodity prices, and trigger investor reactions from São Paulo to Sydney. This isn't just about money, it's about psychology, policy, and geopolitics. Why does Wall Street wield this much influence? The dollar's dominance. The US dollar remains the world's reserve currency, and much of global trade is conducted in it. That gives Wall Street, and by extension US financial policy, an outsized voice in global affairs. If Wall Street sneezes, other markets brace for the flu. Technological and institutional infrastructure. Wall Street isn't just home to big banks, it's also the epicenter of some of the most advanced financial technologies and institutions in the world. Its infrastructure, from electronic trading systems to regulatory frameworks, sets the standard for how global markets operate. Many foreign firms list on the New York Stock Exchange or NASDAQ precisely because of the prestige and reach that Wall Street provides. Influence over global investment trends. Major U.S. investment banks and hedge funds influence what sectors rise and fall worldwide. If Wall Street shifts focus to green energy, startups in Berlin or Seoul feel it. If American investors pull out of emerging markets, entire national economies can wobble. Crisis leadership and responsibility. Wall Street is often both the cause of and the response to global crises. The 2008 financial crisis, triggered by Wall Street's appetite for risk and lax oversight, led to worldwide recession. But it was also U.S. financial institutions and the Federal Reserve that led recovery efforts, injecting liquidity and restoring some global confidence. This power isn't always welcomed. Many see Wall Street as the face of economic inequality, speculative excess, and corporate overreach. Others see it as a vital engine of innovation, risk-taking, and growth. The truth is, it's both. Its legacy is still unfolding, shaped daily by economic data, political decisions, and technological advances. But it continues to play the same role it always has, the place where ambition meets consequence, where fortunes are made in moments and lost just as fast, where economic theories get tested in the real world, and where the line between risk and reward defines more than just bank accounts. It defines eras. So yes, Wall Street is still where money is made, but it's also where the story of our global economy is told, every day, in real time. From a wooden wall built by Dutch settlers to the high-tech skyscrapers pulsing with global capital today, Wall Street's journey is nothing short of extraordinary. It began as a simple trading post on the edge of a colonial outpost, just a dirt path where merchants and brokers met under a buttonwood tree. Over centuries, it evolved into the financial heartbeat of the world, where fortunes are made in seconds and decisions echo across continents. Along the way, it has financed revolutions, built empires, weathered panics, and shaped every chapter of America's economic story. It helped transform a young republic into an industrial giant and then into a digital superpower. But its legacy is complex, entwined with progress and scandal, innovation and exploitation. So now, as you watch the markets rise and fall, as headlines talk of booms and busts, ask yourself, is Wall Street the engine of opportunity or a fortress of greed? The answer may not be simple, but it might just be hiding in the shadows of its own past. Thanks for watching, and remember, history isn't just about what happened, it's about what it still means. Before you go, we want to hear from you. What part of Wall Street's history shocked you the most? Was it the secret pact under a buttonwood tree? The sheer power of JP Morgan during a national crisis? Or maybe the modern chaos of the 2008 crash? Drop your thoughts in the comments below. We read everyone. And if you want more untold stories, like this, check out these next. The Gilded Age, America's most corrupt era. The 2008 crash explained in 10 minutes. Don't forget to like, subscribe, and hit that bell icon so you never miss a deep dive into the moments that shaped our world. Until next time, stay curious.